The most dangerous sentence in investing is not, "This stock is going to the moon." It is, "I am just buying the dip." Because a dip sounds safe. It sounds disciplined. It makes you feel like the patient person in a room full of emotional traders. But here is the uncomfortable part. A dip is not always a discount. Sometimes it is just the moment when earlier investors finally have enough liquidity to leave. Buying the dip feels smarter than chasing a rally. You waited. You saw the price fall. You told yourself the panic is overdone. That story is emotionally powerful because it lets you feel cautious and aggressive at the same time. You get to say, "I am not gambling. I am being opportunistic." But the market does not care what the trade feels like. The market only cares about one thing: who still needs to buy after you? Exit liquidity sounds like a brutal phrase, but it describes something very simple. Someone bought earlier, they're sitting on gains, they want out. But they cannot sell unless there is another buyer. So the story has to stay alive long enough for new buyers to arrive. That is why late-stage markets can feel so confusing. The price falls a little, but the narrative does not die. The headlines still sound bullish. And suddenly, the dip does not feel like danger. It feels like your chance to finally get in. That is the trap. This usually happens after a story has already worked. AI stocks already ran. Bitcoin already had the comeback. Gold already became the safety trade. By the time ordinary investors hear the clean version of the story, the early money may already be thinking about risk, not opportunity. That does not mean the asset is bad. Great companies can become crowded trades. Real trends can become overowned. Good stories can become terrible entries. Here is a simple test. If the only reason you are buying is that it used to be higher, you are not analyzing value. You are anchoring. If the dip makes you excited, ask one colder question. Who is selling to me, and why? I am not saying every dip is a trap. Some of the best investments in history came from buying fear, but the difference is structure. A real dip buying opportunity usually has at least one of three things: improving fundamentals, a valuation that is actually better, and a plan that does not depend on an instant bounce. So before buying the next dip, stop asking, "Can this go back up?" Almost anything can bounce. Ask, "What would make a new buyer pay more than I am paying today?" That question forces you to look past the old chart, past the hype, and past the comfort of a lower price. It makes you think about future demand. This is why buy the dip can be so dangerous. It sounds like patience, but sometimes it is just a prettier name for arriving late. A dip is not automatically a discount. A lower price is not automatically value. And a popular story is not automatically a good entry. The one thing I would watch is not just the price. Watch the story. If the price is falling and the story is only getting louder, be careful. That noise may be the exit door opening.